It was a strong day on Wall Street as we saw the S&P 500 advance nearly 1%. A big chunk of that move is as a result of Tesla responding quite nicely to its earnings report. That stock was up almost 10% here today and was the reason why consumer discretionary was the leading sector here today. Really the only sector that sat out today's advance was energy, and I've got some really surprising statistics regarding energy from a sector selector perspective in tonight's video when we take a look at that particular tool. So we'll take a look at all of that, see what it means for our postures across the various indices, which we did see some change here today, some notable change, and then I'm going to get into the trade application example where I wanted to feature selling a bear call spread on a very well-known bank to kind of offset some of the bullish deltas I already have in my portfolio. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host Brandon Van Zee. It's July 21st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. At the bottoms of those emails, we'll also let you know if there are any stocks in the S&P 500 giving us overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. We've got our S&P 500 heat map pulled up here in front of us, and as you can see, there was a lot of green on the screen today. Now this has been kind of a repeating pattern here over the last week or so. Of course, many of you know I just got back on track here after a nice family vacation, and so I was happy to see that the markets were mostly up while I was away, and today kind of continued in that theme. We'll see how long this lasts. As I speak right now, we do have some stocks reporting earnings after hours tonight, including Snapchat, that are down significantly. That particular stock is down like 25% right now, and so maybe a little bit of a sour note going into tomorrow morning's trading, but as of this afternoon's closing prices, there were a lot of things to celebrate. You can see Tesla received a standing ovation from investors as it was up nearly 10% today after reporting its own earnings. And you also see that Thermo Fisher and Danaher were up significantly. Danaher was up 9%. Thermo Fisher was up in sympathy, up nearly 7%. That's actually a name that we have in one of my classes there, so we were happy to see that particular move. In addition to that, we saw a lot of technology-oriented stocks doing quite well. Microsoft and Apple both up about 1% or thereabouts. And then we saw that Intuit was up about 3%. Qualcomm was up about 3%. You see that NVIDIA was up over 1%. PayPal over 3%. So this was a particularly strong area of the market. Yes, there were a handful of stocks like Intel and IBM that lagged a little bit, but all in all, a strong day for tech-oriented firms here today. In the more defensive areas, we did see a nice move higher out of Philip Morris. That was up 4%, but keep in mind that stock had been down quite a bit prior to reporting earnings this morning, so perhaps just kind of bouncing back and gaining back some of what it lost in recent weeks. Otherwise, you did see that it was kind of a mixed bag with consumer staples here today. Energy was a clear loser today. In fact, it looks to my eye that Kinder Morgan was the only winning stock from the energy sector within the S&P 500. It was up about 2% here today. All the others are in the red here, with Valero suffering a nearly 5% loss here today. Speaking of losers, let's talk about AT&T. Stop me if you've heard that before. Just joking, of course, but AT&T has been quite the losing trade and position for many years at this point, and today was more of the same. They reported their earnings and the stock was down 7%, which caused its competitors Verizon and T-Mobile also to finish a bit lower here today. So all in all, a strong day for the markets here today, up nearly 1%, and it was a pretty broad-based rally with really the only major holdout from a consistent perspective being energy, and then kind of having consumer staples lagging to a degree here as well. But otherwise, a lot of green out there, so it was another broad-based advance here today. Let's go ahead and now take a look at our specific numbers within the S&P 500. Over here on the main part of the platform, and you can see I'm on the Market Watch Visualize area with the S&P 500 watch list pulled up, and out of those 500 companies, 364 of them did close higher here today. So that was good for about 73% of the components within the S&P 500 did close in the green. So again, just reiterating, it was a pretty broad-based advance here once again today. Let's go ahead and now take a look at our charts. This was almost one of those days where I would start with the 1% mover on the S&P 500 on that other chart starting with 6, but we didn't quite get there. 0.99% was the advance for the S&P 500. However, in recent days, we have seen a couple of at least 1% moves higher out of the S&P 500, and today you could nearly qualify as that type of a move as well. So I believe it's 3 out of the last 4 or 5 days we've had effectively 1% plus moves, which is a really good sign. I would say that there's a lot of constructive activity taking place from a charting perspective. Of course, never know when that might fail, but on the healthy side of the conversation, what I would simply point out is that as you look at these 4 charts in front of you, we are now trading with the most amount of separation between current price and the 30-day moving average of the last 3 months. So in other words, when you look at the current price of the S&P 500, the current price of the Dow Jones Industrial Average, current price of Nasdaq Composite, and then the current candle over here of the Russell 2000, notice how there is an air pocket underneath each of those candles before you get down to the 30-day moving average. There is separation there. And that had generally not happened in the last 3 months. We talked about this last time I was with you a week or so ago before I went on my vacation, and I was saying how that is one of the things that I'm going to be looking out for, because that's one thing that will be required if there is a legitimate chance for this market to actually turn around and not just have your typical dead cat bounce that we've been dealing with so often in 2022. As you look back at prior attempts, you'll notice the S&P 500 basically tapped the underside of the falling 30-day moving average right there. It did so right there. And then you can see during this time period back here in early June, it did manage to close above the moving average in a number of days. But notice how those candles were constantly touching the moving average at the lows of most of those days. There really was not any separation, especially compared to what we are witnessing right now. So I think that's a very positive sign. This time feels a little bit more substantial. Now, whether it amounts to anything or not, we'll all find out together, but it's got to start somewhere if there is going to be a recovery, and this is a good first step towards that recovery if we can start kind of continuing to separate our price versus the 30-day moving average. Remember, the next step now that we've got a little bit of wiggle room is to have enough time spent above the moving averages that the colors of the moving averages change to green. At this moment in time, you'll notice that all 4 of these moving average colors at the current spot is yellow. And in this case, what that signifies is price is above a falling 30-day moving average. But remember, the way that the 30-day moving average is constructed is you're basically taking the candle from the 30th day back, taking that out of your calculation and adding the newest day to that calculation and rinsing and repeating that process as time goes on to plot that line. And so eventually you'll start getting rid of some of these really terrible days back here 30 plus days ago, and you'll start adding more good days to the calculation more recently. And as that takes place, eventually you'd like to think that that moving average will start to rise. And I think there's a very good chance that will happen, especially for the Nasdaq. As I eyeball this right now, it looks like that moving average is really close to flat. And so flat is typically where you end up when you start downtrending. You go flat and then eventually you start that uptrend. And so the Nasdaq, I think, stands a pretty good chance of seeing its 30-day moving average change to green first. These other ones still have a noticeable slant lower in their moving averages, so it might take a few extra days on the other indices. But the Nasdaq, theoretically, if we have another big day tomorrow going into the weekend, it's possible we could actually see that moving average bend a little bit higher starting tomorrow. So let's be on the lookout for that. Of course, David will be with you in the video over the weekend, but that's one thing that I would want to keep my eye open towards. Now you'll notice that today was also an important day, not just from a moving average perspective and where we stand right now versus that moving average, but also in terms of how we establish our posture using the market forecast technical indicator. A reminder to those of you who might be newer to this video, this indicator below each of these four charts is the market forecast technical indicator, which you can find on Thinkorswim and TD Ameritrade resources. It is proprietary to them, so you won't find it at other brokers. Nonetheless, gives us a unique way to gauge what's taking place within the market and start setting our expectations and different things like that. And we did have some positive signs from that perspective here today. As you see, the S&P 500, the Dow Jones Industrial Average, and the Russell 2000 all changed color schemes from light green yesterday to dark green today in the background color. And what that signifies is our posture going from weakly bullish to now being considered strongly bullish. And so that's a positive sign there. Now remember, the Nasdaq already did that yesterday. And so that one is kind of leading the way at this moment in time, as this rally that we've had here over the last week or so seems to really be involving the growth stocks. And remember, that's a little different than what we've been witnessing for most of 2022, where we had been seeing kind of the value and dividend stocks and the lower volatility and defensive sectors and all those areas kind of outperforming the growth areas. But over the last week, that has not been the case. This has been a market rally that has been led higher by a lot of the riskiest areas of the market and is a good sign for risk appetite. Now, whether that's enough to actually reverse a massive downtrend or not, we'll all find out. But at least it's a good sign for the moment and something that you can kind of bank on and say, hey, there are good things brewing underneath the surface. So the Nasdaq, you'll notice, currently has an intermediate reading of 66 and rising in this green label down below. So this green line is the intermediate line and is what we use to establish our posture in this video, unless you hear us state otherwise. And so as you compare that number in that green label to the S&P 500, which is at 52, to the Dow Jones, which is at 54, and the Russell 2000 at 53, notice how all of those are right next to one another, 52, 53, 54. They're all rising and they're all above the chart's midpoint or the indicator's midpoint, so that's why they've gone to strongly bullish as of today. But the Nasdaq is at 66, considerably higher than the other three, and therefore that is just yet another way to say that the Nasdaq looks to be our current leader of this market, in addition to what I'd mentioned before, that to my eye, it looks like it's going to be the first one that makes that moving average bend higher and convert to a green moving average sooner rather than later. But the Nasdaq appears to be our winner at this moment in time. Not only is it our winner from an intermediate perspective, but it was our winner today as well. It was up 1.36% today, barely besting the S&P 500 at 0.99%, the Dow Jones at 0.51%, and then the Russell 2000 was our relative laggard today. It only advanced 0.48%. So it looks like we have some early signs of a recovery. Now it's just a matter of whether we can see a taming of inflation, maybe a ceasefire in the Russia-Ukraine war situation, maybe the Federal Reserve kind of giving us some guidance as to when it will stop raising interest rates, but those are very lofty wishes and goals, and I'm not sure we'll actually see a resolution to any of them anytime soon. So in other words, just tread cautiously. We do have bullish signs around us, but it doesn't necessarily mean we're out of the thick of it quite yet. But as of right now, we are back to strongly bullish postures across the board, but that is then offset by downtrending 30-day moving averages, which do stand a good chance to actually start reversing, led higher by the Nasdaq first off here within the next week or so, assuming that Snapchat and some of these others that reported earnings here tonight don't crater the market as soon as tomorrow. All right, let's go ahead and step away and take a look at the internet here briefly. I always like to get a chance to say thank you to those of you that help support this free presentation that you're watching on YouTube. Many of you know that it takes about 3 hours minimum for us to do these videos, and we don't have a staff, so it's just David and I doing all of it, and we don't get paid to do it, and so we do it hopefully to educate you guys. We do it hopefully to get the word out about our organization to those who eventually might sign up for our premium subscriptions. But it is somewhat debatable as to whether it's actually worth doing these videos as often as we do. And so if you want to help mold our minds, so to speak, to suggest that you do get value out of these videos and you do want us to continue to provide these for free for you, we ask one simple thing in exchange for all the hours that we put into this. Simply click like for us there on Twitter. As long as I'm up and over 100 likes on the last time I did the video, I will plan on doing another full-length video the next time I'm scheduled to do it. Remember, I do the videos on Tuesdays and Thursdays. David does it the other days. And so the last time I did the video before I went on vacation, you guys did step up to the plate. 109 of you clicked like for me, so thank you very much to all 109 of you. And that's why we're doing a full-length video, including a trade application example here right now. I'll make the same deal with you for the next time I'm scheduled to do it on Tuesday. If you guys can click like and over 100 of you get value out of these videos and are willing to take the 5 seconds out of your day to do that, I'll be happy to give you my time on Tuesday as well. So thank you again to everyone who does step up to the plate. I know there are probably things that you'd rather be doing, but in the end, I do think that the trade-off of time that you give up for our time that goes into producing these videos does go into your camp in terms of who gets the advantage on that. So thank you very much once again. Also, while we're over here, a reminder that David taught his ETF portfolio management class earlier today, and I taught my question and answer session for my premium members earlier today. Tomorrow, David will be teaching his technical analysis class at 1 p.m. Eastern Time, so make sure you're tuned into that if you are a premium or a plus member of Market Scholars. Earlier today, when I did teach my question and answer session, we once again had an excellent 3.5 hours to spend together answering questions from the audience. We took a question regarding People's Banks and its status as a dividend aristocrat. I had a question about looking at a 12 grid and how to interpret the color backgrounds of those 12 grids and if you can use other ticker symbols in addition to what I supplied on the default setting. I also got a question on Truist Financial and whether it would be an interesting dividend growth investing candidate. I also got a question about how to think about dividend cuts, and we actually went through a number of statistics of previous recessions and how many dividend cuts we could expect over market cycles, and how to kind of establish an expectation for a future recession if you do believe we're heading into that direction. I also got a question about what to do with dividends in terms of reinvesting them. Do we use automatic drip through our broker for free, or do we accept cash and let that cash accumulate and then perhaps apply that cash to either new dividend stocks at attractive levels or maybe just the ones in your portfolio that are undervalued versus the ones that might be overvalued? So we had a long conversation about that. We also had a conversation about yield on cost, and we used an example of Coca-Cola, and we also used an example of automatic data processing to help folks understand how do you calculate yield on cost, why is it important, how does it help you stay the course as a long-term dividend growth investor, and then we got a question on Apple and how to interpret the weekly candle chart using our trend trading chart that I use for my Monday class. So if you're interested in any of that commentary and you are currently a premium member of Market Scholars, feel free and go and check out the recording, which, as you can see up here, is already posted. I got a chance to talk about my trip a little bit with my students there as well. We had a great road trip here over the past week or so. And so if you are a premium member, feel free to check that out. If you're not a premium member, there's no time like the present to sign up and join all of the wonderful students that we have here at Market Scholars. Also, while we're over here, let's take a look at the sector selector. Since I wasn't with you on Tuesday, as I was out of town, didn't get a chance to talk about last week's sector selector reading. Remember, this gets updated on Friday nights, and I did have my laptop with me on this particular vacation, and so I was able to get the sector selector and factor selectors done when I could find a little bit of spare time, when I had some internet access in the hotels and different things like that. So this is as of last Friday night, and there will be a new ranking as of tomorrow night that all of you will want to be on the lookout for if you're a premium member. But as of last Friday night, we did have consumer staples retaining their number one position within the sector selector. This was their fourth straight week up at the top. There's a pretty decent chance that that will get upended as soon as tomorrow night. So stay tuned to that. I have a general sense as to which sector may be up there. I won't steal the thunder from my class on Monday on that right now, but just brace yourself. There's a decent chance that we'll have a brand new number one as we head into the weekend. We do have utilities and healthcare up there near the top as well. We had a nice advance out of information technology and real estate week over week. And then on the downside, look at the massive tumble that took place with energy. Now, keep in mind, energy is highly volatile. It is not like a typical, really broad sector, something like, I don't know, like a healthcare or an information technology or something like that. Energy it goes guns a-blazing in both directions. And you have to kind of recognize that as you interpret the rankings that you see out of it as well. Keep in mind that from January 1st until right here on June 17th, energy was number one on the sector selector every single one of those weeks. But starting that final week of June, you can see the immense deterioration in energy to, basically, result in them going from first to worst here within just 5 weeks. And so there has been considerable damage done to many of those energy stocks. However, I think it's also important to note that out of all of these 11 sectors, the sector that stands the best chance of having the most robust earnings from a business perspective is going to be energy. It's just a matter of whether the stock market will be willing to reward that or not, and whether they believe it can be maintained going forward, right? A lot of stock market participants are forward-looking, and they might very well recognize energy has very substantial earnings right now, but perhaps they believe that we are at a peak in inflation, and a year from right now, oil prices will be down tremendously, and the profits will also be down tremendously for those oil companies. So we have to acknowledge that possibility as well. But it's been quite the roller coaster ride for energy sector shareholders in the last 5 weeks or so, first to worst. Let's also take a look here at the factor selector. Now, this was updated as of Tuesday night's closing information. Not a whole lot to report on from this particular perspective. You can see that low volatility factor did maintain the number one position for its 5th straight week, whereas momentum was dead last for the 3rd straight week. Momentum has not been in favor in 2022. All of you trend traders out there, I sympathize with you. It's been brutal. It seems like every time a certain trend starts gearing up and you jump aboard that, kind of chasing the price higher, is the moment that bag holders are produced and made as the market has been just vicious around that particular concept, it seems like, this year. So momentum still struggling in that dead last position. All right, let's go ahead and now pop back on over here to the Thinkorswim platform and do a little bit more charting analysis, starting with chart 5A, which is our asset class 12 grid. A reminder that the background colors of these 12 grids will be either light green, light pink, or dark pink. And so there's 4 different possibilities. And actually, technically, there's 5, because every so often you'll see a white one. And if it's white, it basically means that the posture was exactly flat day over day. But that is extremely rare. It only happens, once every blue moon or so. But generally speaking, there are 4 different shading possibilities. And the light green background colors are referring to what we call a weakly bullish intermediate posture. The dark green is a strongly bullish intermediate posture. And then likewise on the pink side of the equation, when they're light pink, like we see with the US dollar in the lower left-hand corner here, that's weakly bearish. But then dark pink, like we see with gold right next to it, is strongly bearish. And so as you look at those 2 charts, that should make some sense in your mind as well, because as you look at those 2 charts, they should look considerably different from one another. Gold has been in a significant downtrend for a long time at this point. It's basically continually being sold off for the last 3 months. Whereas the US dollar is kind of in the opposite corner, where it has been consistently bid up and bought up over the last 3 months. And remember, that relationship is fairly typical. When the US dollar is strong, commodity prices, all else being equal, are generally weak, and vice versa. So the difference at this exact moment in time is that while the US dollar has been strong for the last 3 months, is actually up 6% over that time period. By the way, when you look at that, it's actually the strongest out of all 12 of these, right? If you look at these little black and red bubbles to the right-hand side of the chart, notice that the 6% is the highest one you see out of all 12 of these particular charts in front of us. So the US dollar has effectively been the strongest chart that we're looking at here in the last 3 months. But in the last week or so, it hasn't been nearly as robust. You'll see here that in the last 4 days, we've had, actually in the last 5 days, I should say, 4 out of the last 5 days have been down days for the US dollar. So the weekly bearish posture is just basically recognizing the weakness in the near term, but it's not to the point of where it would call it a strongly bearish posture yet. In order for that to happen, you'd probably need it to breach the 30-day moving average, which you can see is still quite a long ways away from doing. So I would anticipate at this moment in time, all else being equal, that the US dollar will actually find its footing somewhere in the immediate near term to try to catch another bounce higher. But obviously I can be wrong about that, but that's how I'm kind of thinking about things right now. You'll notice that the US dollar is above the rising 30-day moving average. So that's a good sign. And you'll also notice that it was down 0.28% here today. So kind of in a little bit of a limbo land right now for the strongest asset class out there, as we've had some immediate short-term weakness. With gold, as I mentioned before, it's not just immediate short-term weakness that is the concern. It is lengthier than that. This has been weak for many, many months. At some point, you'd like to believe that there will actually be a rebound. Whether that happens or not, we'll all find out. But what I can tell you is that we have had a number of these little green dots showing up on our chart here about a week or so ago, and those are oversold cluster signals on the daily candle chart. And a lot of times you do get some sort of a reversion to the mean bounce. And so I would not be surprised if today's 1.41% advance out of gold is kind of the start of somewhat of a short-term bounce up towards this falling 30-day moving average. But my expectations would be that it would fail once it approaches there. And so this would be an opportunity to kind of reload bearish trades if it looked like it was going to roll over at that point with slightly better prices than are available to us right now. Oil is a little bit of a different animal. Oil had been strong the first part of the last 3 months, And then the last part of the last 3 months, it's been weaker. However, because it's up pretty substantially from the lows here on July 14th, there's been enough push higher to actually give us a weekly bullish posture. Now, when I look at this chart, I'm not overly enthusiastic about what I see. Remember that I've been spending a lot of time discussing commodities with you guys here in the last month or so, spending that extra time on the commodities 12 grid on that day when we had that big bloody mess when it came to the commodities in general. It's not just oil, not just gold, but even extended to the agriculture commodities and other metals and energy areas out there. So I'm still not overly excited about what I see here out of oil's chart, although I do recognize that at least it's shown some resiliency here over the last week, and you just never know when that could take hold. But right now I'm kind of setting my expectations that this will be a short-lived bounce that we have here out of oil. You can see the moving average is clearly downtrending at this point, which could very well end up being a resistance area for it as we move forward. The 10-year Treasury has been interesting. That's been one of the bigger stories this year, where at the beginning of the year we saw surging interest rates. However, over the last month or so, that hasn't actually been the case. In fact, we could extend that conversation and say over the last 3 months. You'll notice right here, this number off to the right-hand side of TNX's chart says minus 0.24%. Now, you usually don't track interest rates with actual percentages, but it does at least prove the point that over the last 3 months, the 10-year Treasury yield is actually down. How's that for a storyline? It seems like headlines have been screaming to us for a long period of time that interest rates just keep going up and up and up, and mortgages are becoming more and more unaffordable. Well, the truth of the matter is the 10-year Treasury yield is actually down over the last 3 months. And so, we're seeing that it's now struggling below its falling 30-day moving average and now has a strongly bearish posture. And remember, for the most part in 2022, that has not been the case. Typically, if you've looked back over a year-to-date chart, you had these pullbacks and then it kind of stabilized and then bounced higher, right? If I were to change this to a... let's do a 6-month chart here. You can kind of see what the 6 months look like. Interest rates are up considerably over 6 months, but they are down just a tad over the last 3 months. And I think that is a little bit of a surprise to people who have not been paying as close of attention. And remember, that could very well be part of the reason why we are seeing the Nasdaq outperform right now. In fact, we talked about this maybe 2 or 3 weeks ago in one of these presentations where I said if you do have that expectation that interest rates are going to start stalling out and moving lower, then the long duration assets like your more speculative growth stocks should outperform in that environment. At least that's what we had seen in years prior to this year. And we are actually witnessing and we're recognizing that right now. The Nasdaq is outperforming the other areas of the market. And part of the reason behind that could very well be because interest rates have stopped going up for the time being. In terms of the opposite of interest rates, of course, bond prices move inversely. So no surprise that long-term U.S. Treasuries were up 1.73% today. Not only that, but you'll notice they are currently above a rising 30-day moving average. It's green there. And the background color is green, telling us that we have a strongly bullish posture on TLT right now. You could make the same case for foreign bonds. However, in foreign bonds case, be aware that we do have an overbought cluster signal. It's unlikely to stall the progress tremendously here because remember we had tons of oversold cluster signals, so it would be a little surprising if just one single overbought cluster signal wrecked that whole setup. So we'll keep our eye on it, but right now I wouldn't read too much into that, even though it is at least worth mentioning that it exists. Additionally, high yield bonds were surging today. That's another good sign for risk appetite. HYG was up 1.18%. Take a look at that candle here today. Closed near the high of the session, and we are now well above the moving average. Now notice that the moving average is still yellow, unlike foreign bonds and U.S. government bonds. So there's still a little bit of work to do there. But it is a very positive sign because usually the high yield bonds are the most speculative area of the bond market, and usually folks are not going to be bidding those bonds up unless they feel reasonably comfortable with the current economic situation. So could this be a head fake? Of course. You saw that did happen over here after a 4-day rally. You then plunged immediately after that. So it can be unwound in a hurry. But this is, I would say, a pretty positive sign taken in consideration with all the other evidence that we have in front of us that participants within financial markets are now willing to take on more risk than they were previously. Bitcoin also has a weekly bullish posture at this moment in time and is trading above its falling 30-day moving average. Bitcoin didn't really move a whole lot here today, but has had a substantial advance over the last week or so, kind of fulfilling upon that role as a risk asset at this moment in time. In terms of the top rung, you do have the S&P 500 large cap US stocks, and then PFF, which represents preferred stocks with strongly bullish postures at this moment in time. However, the foreign stock markets squished in between those two still currently just have weekly bullish postures. In the case of EFA, which represents the developed foreign stocks, so Europe, Japan, Australia, etc., we are back above the moving average. The moving average still falling, but we're back above it right now. Whereas EEM, which tracks China, India, some of those more emerging areas, still is just a hair below that moving average. But I would say, all in all, when we look at all this information presented in front of us, we have a more substantial picture that's being formed here after we've gotten through the first half of the year, which I'll remind you because we've now gone on a pretty cheery run in the last week or two. But remember, for the first 6 months of the year, it was literally the worst start to a year in my lifetime, going back all the way to either 1970 or 1962, depending upon whose statistics you're using. But either way, we're talking about many decades since somebody has seen a stock market start the first 6 months like we did here. So it's a good sign that after that truly awful 6-month start, July has shaped up quite a bit better and kind of gives you the impression that the bulls are still out there looking for opportunities. They're not just rolling over like they did so often in the first half of the year. Let's go ahead and now take a look at our U.S. sectors 12 grid. And remember, this is the market cap weighted version of this. And as you can see, things have improved considerably here as well since I was last with you before my vacation. XLU, which is right down here at the bottom, represents utilities and is the only bearish chart on the board. It's the only bearish posture, I should emphasize. All the rest have green background colors to various degrees. And with utilities, remember, I had not only mentioned here in this video a couple of weeks ago, but I had also posted on Twitter that I had a bad feeling about utilities because a lot of the charts I was looking at that particular weekend appeared to be rolling over. Not a lot of people were talking about it, but it was part of the impetus as to why I chose the Xcel Energy, remember the utility out of one of my old stomping grounds there in Minneapolis, St. Paul area, as a short selling candidate. And I have good news on that front. For those of you that are premium members, you've already been alerted towards this, but for everybody else, be aware that that swing trade that I did where I sold short the shares of XEL did hit our max profit target price here this morning. So I shut down that trade and we locked in our profits, recognizing that the utilities were starting to slip at a time when some of the more growth-oriented areas were kind of taking the baton. So notice the difference between something like technology, which has basically gone up here 5 out of the last 6 days. Look at that straight line higher on technology, and then compare it to the exact same time period here on utilities. We're talking about night and day, two completely different conversations here. Utilities have largely been going down every day. Technology has largely been going up every day. And so that's been kind of interesting and really kind of tells the story of this market right now of where there is an interest from market participants. Market participants are going after the growth stocks once again, and they're leaving a lot of those defensive areas in the dust. So right now, utilities remains the only bearish posture out of the U.S. sectors on the board. Utilities, by the way, were up today. They were up 0.26%, but it wasn't enough to change the posture. Its intermediate line is at 42 and falling at this moment in time. In terms of who the worst performing sector today was, it was energy. So as I mentioned in the beginning when we were looking at the heat map, remember that only Kinder Morgan was up. Every other energy stock within the S&P 500 was down, so this should not be a surprise to learn that XLE itself was down 1.75% here today. Despite that somewhat bad loss today, it was still able to retain its weekly bullish posture because we are still well above the lows that was set here for XLE basically 1 week ago. So it's got a little bit of wiggle room to have a few bad days because he had several good days prior to that. In terms of who the biggest winner was here today, I would imagine it was probably discretionary. Let me verify that. Yes. It looks like it was discretionary. Discretionary was up 2.29% today. And remember, that should be apparent based upon what I showed you on the heat map when I talked about Tesla being up 10%. Remember, XLY is a market cap weighted version of the discretionary sector. So the reality of the situation is there are three major components that do the vast majority of the pushing around and manipulation of the share price of XLY. And those three companies are Tesla, Amazon, and Home Depot. So when one of those three goes up 10%, like we saw with Tesla today, it should not be a surprise to learn that XLY itself had a very strong day as well. And remember, this is, this has gone on quite a run of several days in a row to the upside. Now, where we stand right now with XLY is sitting here right at the tippy top of this prior resistance area back here in the first day or two of June. So it would be a very positive sign if tomorrow we could get a follow-through day and push up and through that prior resistance area there and close above it as we head into the weekend. You'll notice on discretionary, we did have another positive element here today where we did see the moving average color change to green. And as you look around on all of these other sectors, notice that discretionary is the only one that can make that claim. All the others have either a yellow or a red tip to their 30-day moving average. So discretionary, not only today's leader, but also has bounced strongly enough off of its lows to actually bend that moving average higher along the way. All right, let's go ahead and get into our trade application example for the day. And today was one of those kind of goofy days where I wish I had waited until closer to the closing bell to actually initiate the trade. And sometimes that happens, right? I'm always kind of caught in this balancing act between, trying to get the trades done early enough so that way I can send out the information on Telegram so that way you guys can have an opportunity to consider the trades for yourself if you're a premium member of Market Scholars, versus the offside of that conversation, which is the closer you can wait until the closing bell, the more that you can ensure that the reason you're taking the trade still exists upon the close. And today was one of those rare days where I took the trade a half an hour before the close based upon one market condition, and by the time the closing bell hit, that particular condition had evaporated. So that might be a bad sign as we kick things off for this particular trade. But let me explain what it was that I was looking at first off. And so let's take a look here at JP Morgan. Now, what I did in this case was actually a bearish trade. Part of the reason behind that is just looking at the trades that I've already done for the Market Outlook video. Remember, I keep paper money accounts for all the various classes that I teach, so the Market Outlook is separate from the trading rooms that I teach. And we had a lot of our bearish trades roll off our books on Friday at max gain. Now, in one of the cases, Apple, we had to shut it down early at a small loss, but all of our other bearish trades basically expired with our bear call spreads expiring max gain on Friday. So that basically took a lot of our negative deltas out of our account. And then I already mentioned this just a moment ago, but earlier this morning, we shut down our short selling trade on XEL at max gain. As that stock fell down towards our price target. And so that was yet another bearish trade that was removed from our portfolio. So then all of a sudden, I was left with basically nothing but bullish trades left in my portfolio. And I do like to maintain some balance when it comes to thinking about these more short-term oriented trades. And so I was looking for an opportunity to find a bearish trade here today. And the problem was, it was harder to find them than I had remembered a week or two ago, because naturally when the stock market rebounds as strongly as it has in general over the last week or so, most of the stocks are going up at an equally rapid pace, and therefore their charts are probably starting to break out or looking more bullish to the upside. So I had a little bit more of a struggle looking for bearish trades here today, and one of them that I did find was JP Morgan. Now, a half an hour before the market closed here today, when I placed this bear call spread, the blue line was actually trending lower. And so, there was actually a pink background color behind this candle that we're looking at here today. That was part of the reason or the justification for me to take a bearish trade. So that's why I mentioned before that I feel a little bit goofy now, knowing what I know now, that JP Morgan rallied about 40 cents in the last half an hour or so, and it actually changed the blue line from going down to going back up, and therefore we now have a strong, or not a strongly bullish, but a bullish near-term posture, in addition to a weekly bullish intermediate posture. However, I would still say that a couple of the things hold true for this being a reasonable bearish trade at this level. And what I had liked about it is the fact that it just hit a new 52-week low here on July 14th and has rallied since then, just like the rest of the market. But you'll notice it has not yet breached its falling 30-day moving average. It's right there, basically setting up right on the underside of it. Whereas all of those other major indices out there, remember, we already had air pockets between where they're trading now below it to the moving average. This one hasn't even breached beyond the moving average yet. So it tells you that this is a relative underperformer from that perspective. You can also see that and identify that with your own eyes right here over the last 3 months of this particular chart. That dotted S&P 500 line is currently above the price candle for JP Morgan, ticker symbol JPM, and therefore telling us that the S&P 500 is now outperforming JP Morgan. You can also see that all of our labels up at the top are red at this particular moment in time. Everything from year-to-date performance, from a one-year look-back performance, all of them have a minus sign in front of them, telling us that this stock has been weak on multiple time frames. And therefore, every time it's tried to rally in the past year, it has effectively failed. And therefore, we see no reason to say that it wouldn't happen yet again moving forward. One thing that I will point out is that I actually think JP Morgan is a pretty good long-term investment here. And that might put me at odds with this particular trade. But remember, this particular video caters to the short-term trader and is a little different than what I will teach you guys in my dividend growth investing class. But from a long-term perspective, I actually think JP Morgan is kind of interesting at these levels. However, in the short term, I can also recognize objectively with my eyes that this stock has struggled to stay above its moving average. And in this particular case, what I did is I sold the 120 strike and I bought the 122 strike. Now, those are both calls. So I sold the 120 call and I bought the 122 call. And those are for the month of August. Another challenge I had today was looking for companies that didn't have earnings coming up in the next few days. So many companies are going to be reporting earnings in the next 2 or 3 weeks. So this is one that has already reported. And so that's out of the way and we don't have to worry about some sort of a crazy gap against our trade. So could it go up to 120 or above between now and August? Of course. If the market takes hold and the bulls have their way and push markets higher, this one could obviously be at a disadvantage in that particular situation. But remember, all the rest of the trades I have in the market outlook category right now are bullish. So in a way, you can kind of think of this as like a sacrificial lamb. On the other hand, if this thing starts stalling out because markets have advanced a little bit too far too fast in the short term and roll over again like we've seen in other times this year, then maybe this is one of those bearish trades that can assist us there along the way. The other thing I would mention about this here real quick is if I come over here to the zigzag chart. So this will be chart 6H for those of you that are premium members following along at home. This by default is looking at the movements of 1%, and it's usually designed to look at it on an index basis where 1% means something. When you pull this up on an individual stock, stocks of course move 1% all the time, so it's not quite as obvious as to why it would benefit you looking at it. So what I tend to do when I look at an individual stock here is I would come up here to the Edit Studies area, this little beaker icon above the Thinkorswim chart, and then where you see the zigzag percentage, you can see kind of right here that it's only looking at a 1% move. If you want to change that, just hover over it and then come over here to this little gear icon and then click on it, and then you could change it from, let's say, 1% to 5% instead. I'm just going to hit OK and hit OK again, and now you can see there are a lot fewer tags on this particular chart, and it's basically just showing us the bigger movements here or there. And what I wanted to point out when I pull up JP Morgan, so let me do that, it's on SPX right now, so here's JP Morgan. What I wanted to point out is that it's currently about 7% off its low from a week ago. And that is typically right around a point where it starts stalling out. The biggest counter trend move that JP Morgan has had in the last 9 months has been this one right here at the end of May, and it advanced about 12%. If this current move advances 12%, it would put us up there at around 121. And so that would be right between my strikes. But remember, that would only be a threat if it would close that expiration period exactly right there, which the odds of that happening are pretty slim, I would venture to guess, because it might very well roll over a day or two after hitting that high. And so basically the bet that I'm making here is that between now and the middle of August, that the bounce that we're currently in the midst of will not advance beyond whatever the strongest bounce has been over the last 9 months. All these other ones, here's an 11% move, here's an 8% move, here's a 9% move. Those types of moves I can withstand. A 12% move could get me in trouble if it happens to coincide with options expiration date, which the odds of that are probably pretty low. That doesn't mean that this time couldn't be different, and this actually does change the trend, but if you're thinking in terms of, hey, I'm going to bank on the future somewhat looking like the past, then this could be a trade that is added to a portfolio for a short-term basis if you need some bearish deltas, as I do in my paper money accounts case. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. If you did, I ask one simple request out of you. Just click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video on Tuesday, I'll be happy to give you another full-length video, including another trade application example. If you prefer the shorter videos and you don't like these lengthier videos, and you only want a 15-minute version of this video only covering the indices and no trading example, then don't click like, because if we're under 100 likes, then I'll just plan on doing a quick hitter type of a video. So I'll leave that up to you guys collectively as to what you prefer. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.